Hello friends, this is Sanjeev Kaushik and welcome to my channel Methodical Trades. In this video, I'm going to share with you 4 trading truths that I wish I knew when I started my journey. So let's get started. Truth number 1 is about losses. Those of you who have been tracking my work would know that I'm a great fan of keeping position size small so that the losses are also small. But that doesn't mean that one cannot trade with big positions. No. You can trade with big positions. You can take losses 10, 15, 20% of your total trading capital. But if your profits are also in same proportion as your losses, in other words, if on a single trade you end up losing 10, 15% of your capital, then you should also be able to make 10 to 15% of your capital in a single trade, right? And you can equate this example to a single trading session, a single trading month, a single trading year, and so on. So your losses and profits should be in same proportion. What usually happens with traders is that they end up taking very big positions. Their losses could be 5, 10, 15% of their capital, and sometimes they end up just wiping out their account completely. But their profits, when they are able to generate, if any, are say 1%, 1.5%, 0.5%, 2% max, right? At 2%, they would want to just exit. So if you want to take big positions, there's no harm in that, but ask yourself, are your losses in proportion to your profits as well? If that's not the case, then of course stick with small position sizing because you haven't gotten to that level where you can take on big positions with high conviction. Truth number 2. And this is about scaling in your trading. And this is an issue that I've seen more often with people who have been trading with a lot of success. Let's say if they have been trading with 10,000 bucks. In 10,000 bucks account, they might have been habitual of taking losses of 500 bucks, 200 bucks, 300 bucks, right? So going with 1 to 5% that one would allow himself to lose on a single trade. Now, when they start scaling, then it becomes harder for them to see losses bigger than what they have been seeing. So if someone who has been trading with 10,000 bucks all of a sudden starts trading with, let's say, $1,000,000, then in a single trade, they might see P&L of 1%, which is 10,000 bucks. Earlier, their entire trading capital size was 10,000, and now if they scale to 1 million, then the volatility in their portfolio, even with 1 to 2% profit and loss, would be again in 5 figures, 10,000, 20,000. And this is something many people find it hard to come to terms with. So scaling is in your mind first, and then you do it actually. So the truth about scaling is that you cannot overnight start trading from a $10,000 account to a $1 million account. Just because you think that you have been profitable in 10,000, you can just equate the same thing and now you can also be profitable in $1 million account. No. You have to mentally prepare yourself. So scale, but scale slowly. Do not scale exponentially because that can end up biting you very hard. This brings me to truth number 3, and that is the truth about perfect timing on exit. You join whichever trading course, you can read as many books as you want. One thing you will never be able to perfect, one thing that no trader has ever been able to perfect, including myself. I'm a nobody, but all the greats also. When they retire and you ask them, what is it that you could not master in your trading? Invariably, the answer would be, I could never master my exits. You see, a lot of traders will tell you how to enter a trade, right? What's the best way of entering a trade? What's the best strategy? What's the best system? But most of them have no idea when to exit their trade, when to take the profits, when to take the losses. In fact, it's easier on the sides of losses because if you're disciplined, you will exit at your stop losses, right? But on the profit side, you would never have a perfect exit. And it took me a very, very long time to realize. Sometimes I would end up losing all my profits just because I didn't know when to book them. And you know, as they say, when we are in profits, our position size feels so small, but when we are in losses, our position size always feels very big, right? You know, when you're running profits, you should know how to protect your profits. But more often what happens is we are taking our decisions on exits based on the recent decisions that we took, right? So there's a little bit of recency bias that always comes in our trading. That is, if in past few trades you end up taking your profits prematurely and you saw that the asset has gone up a lot or gone down a lot, depending upon whether you were long or short respectively, then due to your recency bias in your current trade, you will look to stay in that trade longer. Why? Because you know that in your very recent trades, you actually took your profits prematurely. And same is the case when you ended up sticking in a trade longer recently, but what happened is you actually gave back all your profits, and sometimes you might end up taking losses in such past trades, which are recent trades. And then what's going to happen is in your current trades or in your very next trades, you would exit prematurely. And do not beat yourself up. You see, the problem is, and why most of the traders say that they can never master the exit, is because they focus too much on those trades where they exited prematurely, because they would keep going back and keep looking at the potential profit that they left on the table when they closed out their position. What they do not focus at is all the other trades where they might have actually timed their exit perfectly, because they don't have to go back to that trade, right? So this is exactly where we all go wrong. We look at where we could not do the things in a right way. We ignore all those trades where we actually exited at the right time. And that's why we think that we can never master the exit. Right? Of course, there is a little bit of art, there is a little bit of science, and I try to make sure that people who come and join my course, I always try and teach them how to stick in a particular trend as long as they can. I share some very statistical ways, some formula-based ways, some very methodical ways of making sure that we pick the largest chunk of the trend in our profits. But still, it's hard and it comes with practice. But know that you don't really have to beat yourself up for not doing the perfect exits on all your trades. There will never be any perfect exits. There's always a little higher level where you could have sold, and there's always a little lower level where you could have bought. But those levels are just fancy. You would never be able to achieve them. And lastly, on the same point, why do we focus so much on our mismatched timing? Because taking losses from stop losses is still less painful. Over a period of time, it just becomes a part of process. But something that one can never come to terms with is the potential profit that they lost out on by, of course, booking their trades prematurely. Because as it is, finding the profitable trades are a challenge in itself. And once you found one, it becomes even more painful to know that you couldn't potentially capture all the profits which you should have by sticking in the trade longer. So we focus a lot on our premature exits, but we do not focus at all on the trades where we actually timed our exits perfectly. This is the truth. I realized a lot later, and I do not at all care where I exited. I exit, and of course I would stay in touch with the counter, but I wouldn't really let myself be disappointed just because I exited prematurely. There's always going to be a next trade. There's always going to be the next opportunity. What has happened has already happened. Time to move on. And this brings me to the fourth truth about trading, and that is the truth about having an edge in market. You can gain edge in the markets in a lot of ways. One of the ways is by implementing a strategy that has a success rate of more than 50%. Why is it so? Let's say you have a trading strategy that has a success rate of just 51%. That's it. No more, no less. 51%. What does it mean? It means out of 100 trades that you're going to take, 49 will give you losses and 51 will give you profits. Let's say that we go with the proportionality between losses and profits, and that we just lose as much in our losses as much we make in our profitable trade. So what does it mean? With a 51% success rate, 49 trades would lose you money and 51 will make you money. So the 49 losses will negate the 49 profits, and now you will only be left with 2 profitable trades. In other words, for every 100 trades that you take, you're going to take loss on 98 of them. This is what 51% success rate actually means. So if you know that statistically, out of every 100 trade, you're going to make profit only on 2 trades, then you would know it's just a matter of taking on more and more trades. That's it. After taking 1,000 trades, your profitable trades would be 20, and after taking 10,000 trades, your profitable trades would be 200. So with a 51% success rate, you can still be profitable. But if you're someone who would go back and check your trading records of, let's say, past 1 month, 6 months, you will see an ocean of red, because almost 50% of the trades would look like you lost money on them. And of course you did, so they would show in red. But when you think of your strategy's success rate in statistical terms, then you would know that with a 51% success rate, you will make money. In fact, there are traders who make money with success rate less than 50%. Yes, their strategy works less than 50% of the times, but they're so good in money management or risk management that whenever they take losses, they take very small losses, and whenever they take profits, they take huge profits. So that's another way of making sure that one remains profitable. But even if you can't find those kind of strategies, because usually those strategies are rare find, the trades under those strategies are also rare find, then at least look for a strategy that has at least 51% success rate. Now equate the same with 55% or 60% success rate. With 60% success rate, you would know that out of every 100 trade that you're taking, 20 will give you profit. And then people say, I want something that works 80 to 90% of the times. No, you don't need that. Even with a 60% success rate, out of every 100 trade that you're making, you're going to make money in 20% of those trades. 20 out of 100 trades will give you profit. You need to understand that. This is just maths, nothing else. All you have to do is make sure you follow the process systematically. Completely mechanical about your trading. Why? Because you know that doesn't matter what happens. I have a strategy with, say, 60% success rate, and at the end of the day, I will take losses on 40% of the trades, and I know that I will make money on 60% of the trades, and eventually I will be profitable in a long run. So these are the 4 truths about trading that I wanted to share with you. I hope that this is going to be helpful. Do let me know in the comments if you have any feedback for me. Thank you, and I'll see you soon.